It's kind of crazy. We always hear these stories about startups hitting it big, like overnight success kind of thing. But the reality is, for every company that reaches escape velocity, there are a ton more that just, well, they just don't make it. And you're left wondering, what's really going on behind the scenes? What determines whether a startup makes it or breaks it?
It's the question everyone wants answered, isn't it? And
Yeah.
yeah, trying to figure it all out can feel like you're drowning in information overload.
I know, right? So, for this deep dive, we did the hard work and sifted through a mountain of material to try and make things a bit clearer for you. We've got some serious academic stuff like the impact of funding on market valuation, sharp insights from Bill Gurley's All Revenue is Not Created Equal, direct perspectives from founders and investors via TechCrunch and Clouded Judgment, and the data-packed Startup Genome Report too.
We're basically trying to boil down all this knowledge from these different places. We want to give you a better sense of how those crazy startup valuations actually happen, why just looking at revenue can be really misleading, and what actually drives those venture capital decisions.
Mm.
And maybe the most important thing, the big mistake of premature scaling that can kill a startup. Think of this deep dive as like your cheat sheet to navigating all this stuff without getting lost in the weeds.
Okay, so let's just jump right in and talk about valuation. That big number everyone seems to obsess over. How do we even begin to figure out what a startup is actually worth? I was reading Aswath Damodaran, and he said something that really stuck with me. You can value an asset based on its fundamentals, cash flows, growth, and risk, or you can price it based on what others are paying for similar assets. And those two things can actually give you different numbers.
He's got a point there. He's making a big distinction between looking at the inner workings of a business, like how good they are at making money, how fast they're growing, and the risks they're facing, versus just looking at what similar companies are selling for right now in the market.
And it seems like that second way, just using a simple price to revenue multiple, would be really easy, right? But Bill Gurley seems really worried about that. He calls it a simplistic and crude tool and warns that all revenues are not created equal.
It's interesting how concerned he is about this. Curley says the ideal way to value a company is through discounted cash flow. Basically, you project future earnings and figure out what they're worth today. But with young startups, those projections can be way off. He puts it pretty bluntly, garbage in, garbage out. These companies don't have tons of historical data, and new markets are unpredictable. Accurate forecasting, it's tough.
So because discounted cash flow can be so hard to figure out for young companies, people often just go with those simpler multiples. But Gurley argues that a dollar of revenue from one business can mean something completely different, have a totally different long-term value compared to a dollar from another business. And he brings up this crazy example from 2012 showing internet stocks with price to revenue ratios all over the place. Overstock was at 0.2x and Youku.com was at a whopping 21.7x.
100 times difference in how the market valued a dollar of sales. It shows you that a simple revenue multiple just doesn't cut it. And like Gurley said, most companies back then were trading below 4x, and only a handful made it to that 10x club.
10x revenue club. That sounds pretty exclusive. What does it take for a company to get in there, according to Gurley?
He lays out a few key things, some of which have evolved over time. But the most important one, the foundation, is what he calls a sustainable competitive advantage. Warren Buffett calls it an economic moat. Imagine a moat around a castle. It makes it really hard to attack. He compares Coca-Cola, a slow-growing company with a really strong moat, to RIM, BlackBerry. RIM was growing fast, but its future wasn't as certain, so it had a much lower multiple.
It makes sense. What else makes a dollar of revenue more valuable to investors?
Network effects. They're super powerful. Think about platforms where more users make the platform more valuable for everyone, companies like Microsoft, eBay, or Facebook. It creates a cycle that feeds itself, much stronger than just getting bigger and cheaper.
So a strong position in the market, hard to win back, and network effects. What else is there?
Visibility and predictability. Investors love recurring revenue streams, like a SaaS subscription model. It makes forecasting future cash flows much easier than one-time transactions, like selling a video game versus a subscription to Salesforce.com, which is one of his examples. But there are exceptions, of course, like game companies that own platforms, like Tencent. They have a more predictable revenue flow because users stay engaged.
Predictability seems like a no-brainer for investors. What about keeping customers happy and coming back?
Absolutely. Customer lock-in and high switching costs are huge. If it's hard or expensive for customers to switch to a competitor, maybe because of technical integrations or the hassle of moving data that really lowers your churn rate, And low churn means each customer is worth more in the long run. It can really boost a company's valuation.
Okay, so we've got a strong moat, network effects, predictable revenue that keeps coming in, and customers that stick around. What else drives a high valuation?
Gross margin levels. They directly impact how much cash a company can generate from its revenue. Higher gross margins mean more money left over after covering the cost of making their product or service. More money to put towards profit. He compares Amazon, Walmart, and Best Buy to show this.
That makes sense. But what about how profitable a company gets as it grows bigger?
That brings us to marginal profitability calculation. Investors want to see that as a company grows, its profit margins get better, or at least stay healthy. If the cost of getting each new customer or making another dollar goes down, that's a good sign that the business model can scale. Gurley talks about how Google actually had negative incremental marginal profitability in one quarter as a warning sign. And it explains why companies that rely heavily on human capital, like consulting firms, can struggle to get super high valuations.
Interesting. Are there any red flags that can really hurt a valuation multiple?
Definitely. Customer concentration. If a big chunk of your revenue comes from just a few big clients, you're in trouble if one of them leaves or demands a better deal. Another risk is major partner dependencies. If your success depends on another company's policies or platform, like how Demand Media used to rely on Google's search algorithm for traffic, or Kayak, depending on ITA for flight data investors, might see you as risky because you don't fully control your own fate.
Makes sense. Lack of control is definitely risky. Anything else that can drag down a valuation?
The way you get customers matters. A company that attracts customers naturally, through word of mouth, and because their product is great, is more valuable than a company that has to spend a ton on marketing to get each new user. Think about the early days of Yahoo, eBay, Google, Facebook, Skype, even OpenTable. They all grew organically. Even a super successful company like Netflix, which spends a lot on marketing, usually trades at a lower multiple than those with strong organic growth. Jeff Bezos even shifted Amazon away from big TV ads to focus on customer experience and drive organic growth.
And finally, the big one that probably everyone thinks about, growth itself.
You got it. Strong, consistent growth really gets investors excited and drives those valuation multiples up. The faster you're growing, the bigger those future revenue and cash flow numbers look. And back when Gurley was writing this, there weren't that many high-growth companies going public, so those that did were really hot commodities.
You remember he mentioned some more recent things he's added to that list of factors, right?
Yeah, he now includes stuff like capital expenditure intensity, basically, how much money a company has to spend on physical stuff like factories or equipment. Businesses that need a lot of that usually have lower multiples. He also looks at cash flow versus reported earnings. Companies that generate more actual cash than their accounting numbers show are seen as better investments. Optionality, the potential to expand into new markets or create new business lines, also adds value. And while he didn't think it was that important for public companies initially, he now includes TAM, the total addressable market size, as something to consider.
So it's pretty clear that figuring out a startup's worth is way more complicated than just multiplying its revenue. But who are the big players deciding these valuations in the private market, and what are they really after? Let's talk about venture capital.
Oh, venture capital. To understand them, you have to understand where they get their money. Venture capital firms raise money from limited partners, or LPs. These LPs could be pension funds, university endowments, wealthy individuals. Their main goal is to get a big return on their investment. They want to beat inflation, which, according to that TechCrunch article, was around 9% when they published it.
So there's a lot of pressure on venture capitalists to make their investors happy. How does that pressure shape their approach to investing?
It leads them to diversify. Basically, they spread their bets across a bunch of different startups. Instead of putting a ton of money into one company, they invest smaller amounts in a lot of different ones. The idea is that a few of these investments will blow up, like that example from TechCrunch, where a company in a $30 million fund goes public at a $1.2 billion valuation. And those huge wins will make up for all the investments that don't work out.
So they don't expect every single company to be a massive success story.
Nope. In fact, for a VC investment to really make a difference for their fund, it needs to be a huge hit. Over the typical 10-year life of a venture fund, after inflation and fees, a fund might need to double its size just to give decent returns to their LPs. This means each individual investment needs the potential to return many times the initial investment, maybe even several times the size of the entire fund. A 3x or 4x return, while great for founders and early investors, might not be enough to move the needle for a big venture fund.
Wow, that really puts things into perspective. It's high stakes for sure. Are there any potential downsides or conflicts of interest that come up with this model?
The Clouded Judgment newsletter brought up a really good point about incentives not always lining up between the venture capital general partners, the GPs who manage the fund, and the startup founders. Traditionally, GPs charged a 2% annual management fee on the total fund size and took 20% of the profits, called the carry. This meant their main financial incentive was tied to how well their companies did and how big the exits were, which aligned their interests with the founders.
But the newsletter suggested that things might be changing.
Yeah, the argument is that venture funds have gotten so big that those 2% annual fees have become a big, steady source of income for the GPs, whether the fund is doing well overall or not. This can lead to what some people call a deployment game, where the focus shifts to investing quickly, putting out larger sums of money so they can raise an even bigger fund next time and collect even more fees.
So does that mean VCs might be pushing companies to take more money than they actually need or can handle?
It's definitely a concern. Imagine a founder wants to raise $50 million, but with investors excited and under pressure to deploy capital, they might end up with offers for $100 million or more. While more money might sound good, it usually comes with a much higher valuation, which puts a lot of pressure on the company to grow really fast. And if they can't meet those crazy expectations, things can go south quickly. Founders really need to think about whether a bigger offer means the investor really believes in their long-term vision, or if they're just trying to spend money. We saw a lot of this happen between 2020 and 2022, where some founders mistakenly thought the highest valuation meant the best investor, which wasn't always the case.
And what about this call option mentality they mentioned?
That's when VCs have so much money to invest that they might make a lot of smaller bets without being super confident in each company. The thinking is that even if just a few of those bets become huge successes, the power law in venture capital, those massive wins, will more than make up for all the other investments that flop. This can lead to a less personal relationship between the GP and the founder. The investor might not be as involved in helping the company through tough times. If they weren't that convinced about the company from the start, they might bail at the first sign of trouble.
It sounds like in this environment, startups end up being priced based on what's trendy, not actually valued based on how strong their business is.
That's a really important distinction, especially in a hot market. Venture capital investments can be priced based on metrics like annual recurring revenue multiples or current revenue run rate.
Mm.
It's a quick and easy way to come up with a number, but it can be totally disconnected from the actual strength of the business, how long it can last, and its true value. It's like pricing a can of soda based on what other stores are charging, not on how much it costs to make and how much people actually want it.
And those built-in incentives in venture capital, the management fees and the carry, they seem to push this whole cycle of rapid deployment and crazy growth targets.
Totally. The way venture capital firms make money encourages them to invest quickly to maximize their fees and chase those huge unicorn returns that generate big carry. It creates a kind of treadmill for startups. They're constantly under pressure to raise more and more money to meet those growing expectations that are often inflated, even if it means sacrificing building a truly sustainable, profitable business.
This all points to the dangers of overcapitalization and what we talked about earlier, premature growth.
It's exactly. There was an academic study on the UAE startup ecosystem. They found a U-shaped relationship between the amount of money raised and the final valuation. It suggests that while some funding is crucial, raising too much too early can lead to lower valuations in the end. Fred Wilson, a famous VC, said, "Less money raised leads to more success." It sounds counterintuitive, but it's true. If you invest heavily in growth before proving your core business model and finding product market fit, you're setting yourself up for failure.
Which brings us to premature scaling. The Startup Genome Report 2 says it's a huge reason why startups fail, a whopping 74% of high-growth internet startups in their analysis. What exactly do they mean by premature scaling?
They define it as scaling any part of the company: customer acquisition, product development, hiring, financial investments, even the business model itself, before you've proven there's enough customer demand for what you're offering and before you found product market fit. You know, that sweet spot where your product really solves a big problem for a lot of people. It's basically like trying to run a marathon before you can even walk.
And they make a distinction between startups that scale consistently and those that scale inconsistently, right?
Consistent startups keep everything: customer growth, product changes, team size, financial investments, and business model adjustments in line with real customer validation and traction. Inconsistent startups, on the other hand, have a mismatch. They're scaling one or more of these things way faster than their actual customer demand. Premature scaling is the most common and dangerous form of this.
Can you give us some examples of what this premature scaling actually looks like?
Sure. When it comes to getting customers, it often means spending a ton on marketing and sales, maybe big ad campaigns or hiring a massive sales team before you've built a product that people really want and before you know who your ideal customer is and how to reach them. The report uses examples like Color, Web, Van, and Pets.com. They all spent heavily on customer acquisition before figuring out their core value proposition. Their data shows inconsistent startups are more than twice as likely to overspend on getting customers compared to consistent startups.
What about prematurely scaling the product development side?
That often means building a ton of features or investing heavily in tech infrastructure before you've even proven that your initial product solves a real problem for people. It could also mean adding features that early adopters aren't asking for. The Startup Genome Report found that inconsistent startups actually write more code early on and outsource more development work. It suggests they're focused on perfecting the product in a vacuum instead of building it based on real user feedback.
And how does premature scaling play out financially?
This is where raising too much money too early can really hurt. Having a lot of cash can create a false sense of security and lead to overspending. It can also make it harder to change direction later on. The report says prematurely scaled startups are often valued twice as high and raise 3 times more money than consistent startups, even before they start scaling seriously.
So being overfunded can actually set a company up for premature scaling and increase the risk of failure. What about prematurely scaling the business model itself?
That happens when a company tries to expand into new markets, add new revenue streams, or implement complicated operations before proving their core business model is actually working and making money in their initial market. The report suggests that early versions of companies like MySpace and Groupon might have done this.
The Startup Genome Report gives some pretty scary statistics about what happens when companies scale prematurely, right?
Yeah, the numbers are pretty rough. They found that not one startup in their whole data set that scaled prematurely ever reached 100,000 users. On the other hand, startups that scaled at a pace that matched their customer validation grew 20 times faster. And get this, 93% of prematurely scaled startups never even made $100,000 in monthly revenue. They also saw that prematurely scaled startups have teams that are 3 times bigger at the same stage compared to consistent startups, which means a lot of overhead without the results to back it up.
Those are some serious numbers. The report also includes quotes from a bunch of startup experts about this, doesn't it?
They do. Salim Ismail says premature scaling is spending money and resources expecting big growth without the proof to back it up. He warns against launching with too many features, having too many managers too early, focusing on the wrong metrics, and basically just dreaming without real customer validation. Brad Feld gives some practical advice. Hiring a bunch of salespeople or marketers before people are actually using your product is premature scaling. Your early hires should all be focused on technology or the product.
Patrick Polish had that great quote, "If everything seems under control, you probably scaled prematurely."
Exactly. He's saying that the early stages of a successful startup are usually a bit messy as you're figuring things out. Bernard Moon talks about the downside of raising too much money early on. He says it can make you spend carelessly and make it harder to change your strategy if your initial ideas are wrong. Fred Destin warns about illusions of product market fit, where early excitement from a small group is mistaken for real market demand.
Enrique Allen's analogy is great. Premature scaling is when a baby tries to run before it knows how to walk.
It's a perfect picture of getting ahead of yourself. Alex Barrera thinks premature scaling is trying to fix a problem you haven't encountered yet, which often happens when tech-focused founders prioritize the technology over solving a real problem for customers. And Mick Libinskas offers a balanced view. He says scaling too early wastes money and distracts you, but scaling too late means you might miss your chance.
Yeah.
He also says you shouldn't add too many features or target too many different types of customers too soon.
And the report also highlights some things that surprisingly don't seem to affect whether a company scales prematurely or not.
Yeah, that's a key finding. Things like the overall market size, product release cycles in the industry, the founder's education, gender, whether they've worked together before, their experience, age, how many products they launch, what tracking tools they use, and even where the startup is located. None of these seem to significantly increase or decrease the risk of premature scaling. It really shows that it all comes down to aligning your scaling efforts with proven customer demand. They also found that inconsistent startups often try to make money from their users before they've achieved product-market fit, which can actually drive potential customers away.
So the big takeaway is don't get ahead of yourself. Focus on proving your ideas and finding that product market fit before you go crazy with scaling.
Exactly. Build a strong foundation with customers who love your product and a business model that works before you start throwing fuel on the fire.
To see how all this plays out in real life, let's look at Instacart. They went public recently, and Aswad Damodaran did a really deep analysis of their valuation and what they're dealing with in the market.
Instacart is a great example to understand these valuation and scaling dynamics. Damodaran breaks it down really well. Their business is all about being the middleman for online grocery shopping. They connect people with local stores and handle the shopping and delivery.
And they grew like crazy during the height of the COVID-19 pandemic, right?
Oh, yeah. When everyone was stuck at home, online grocery shopping exploded, and Instacart was a big winner. People were even talking about valuations of $50 billion or more. But by the time they actually went public, the price was way lower, around $9 to $10 billion. The market had definitely adjusted its expectations.
Damodaran pointed out some things about the grocery industry that make it hard to value Instacart.
Yeah, he emphasized that grocery stores generally don't grow that fast, and their profit margins are really thin. This puts a limit on how much a middleman service like Instacart can realistically charge. He also says that while more people are buying groceries online, it's probably not going to be as big as other types of online retail. A lot of people still like going to the store to pick out fresh produce and stuff.
And they've got a lot more competition now, right?
Way more. Regular grocery stores have been getting better at online ordering and delivery, often focusing on cheaper options like picking up your order at the store. And then there's competition from other delivery companies like Uber Eats and DoorDash. It's a tough battle for market share, and it could force Instacart to lower its prices.
He also talked about how Instacart's costs are structured, especially the whole debate about classifying their shoppers and drivers.
That's a big issue for their financials. The question of whether those workers are independent contractors or employees could cost Instacart a lot more in labor and really change their whole business model. All the legal battles and uncertainty make it harder to predict how profitable they'll be in the long run.
I remember Damodaran had some complaints about Instacart's IPO prospectus, too.
He did. He mentioned the sheer amount of paperwork involved, how they overplay their tech and AI angle, arguing that they're basically a grocery delivery company that uses technology, how they used adjusted EBITDA metrics that didn't include major expenses like stock-based compensation, and some inconsistencies in how they reported their share count. All these things show the challenges and scrutiny that pre-IPO companies face.
Looking at Instacart's history, that surge in growth during COVID was huge.
Absolutely. Tons of new subscribers and a big jump in transaction value and revenue in 2020 when everyone switched to online grocery shopping. But as things went back to normal, their growth slowed down, although they did manage to become profitable before their IPO.
He also looked at their take rate, basically, how much of each transaction they keep as revenue.
Yeah, their take rate has gotten better, but it's still much lower than companies like Airbnb and DoorDash. He says that's mainly because grocery stores just have lower profit margins compared to things like hotels or restaurants. There's less room for a middleman to take a big cut.
What did he say about their customer acquisition costs and how much money they make from each customer?
He noticed that their customer acquisition costs seem to be going up, which suggests more competition for online grocery shoppers. While the average order size hasn't changed much, he pointed out a worrying trend. Those new customers they got in 2020 are actually spending less in the years after. It could mean some of those pandemic gains won't last.
So based on all of this, how did Damodaran value Instacart?
Based on his own assumptions about the future of online grocery shopping, Instacart's potential market share, what take rate they could achieve, their likely operating margins, and how much they'd need to reinvest, he came up with a valuation that was pretty close to their IPO price. His simulations didn't show much potential for the price to go way up from there.
He also talked about how IPOs are often more about pricing based on similar companies, not a real in-depth valuation.
Exactly. He compared Instacart's pricing multiples to Airbnb and DoorDash, pointing out that their different take rates explain a lot of the variation. While Instacart's price did jump up briefly right after the IPO, Damodaran's analysis suggested the initial price was pretty fair based on the data and what's happening in the industry.
And he wrapped up by talking about how venture capital works, using Instacart as an example.
He thinks venture capital is often more like a pricing game, focused on spotting trends and scaling metrics at the right moment, rather than traditional value investing where you dig deep into a company's fundamentals. The different returns that investors got from different rounds of funding in Instacart really show this. Early investors who got in when the valuation was low made a lot of money. Late-stage investors who got in when the hype was at its peak in 2020 and 2021 saw their valuations drop significantly. It shows the risks and how important it is to understand the real value drivers, not just market hype.
So for all of you listening, what are the big things to remember from this deep dive into startup valuation and the dangers of scaling too quickly?
It's complicated, that's for sure. To figure out why some startups make it and others don't, you need to consider a lot of factors. When it comes to valuation, remember to look beyond those revenue multiples and dig into the fundamentals of the business. How strong is their market position? Can they defend it? And can they grow sustainably over the long term? The way venture capital works, their motivations, and how they operate can have a big impact on a startup's path and how fast they're expected to grow, sometimes prioritizing quick investments over building something that will last.
And scaling too soon can be a death sentence for a startup.
Absolutely. Expanding any part of your business aggressively before you have real product market fit and proven customer demand is a huge trap. It can drain your resources, lead to unsustainable growth, and make you more likely to fail. Focus on validating your core assumptions and building a solid foundation of customers who love your product and a business model that makes money before you even think about scaling up.
Here's something to think about. Given how venture capital works, how can founders handle the pressure to grow super fast and make sure they're building a business that will last, not just chasing short-term growth fueled by easy money? It really makes you think about the long-term impact of every funding decision and every scaling strategy.
We encourage you to check out the sources we talked about today. There's a lot more to learn from them. It's all part of understanding what makes startups thrive and sometimes why they don't.